So imagine a business that is, for lack of a better word, unglamorous.
Oh, extremely unglamorous. Yeah.
Right. I mean, there are no flashy product launches with smoke
No
machines.
CEO in a black turtleneck promising to colonize Mars.
Definitely no viral TikTok trends about this company. We're
No.
talking about, steel pipes buried underground,
Yes.
storage tanks, industrial terminals.
The plumbing of the global economy, really?
Yeah, exactly. But what if I told you that this unglamorous business is basically an income machine?
Mm-hmm.
A machine that just churns out cash so reliably that it's raised its payout to investors for nearly 3 decades straight.
It just runs quietly in the background, keeping the modern world powered while everyone's distracted by the latest volatile tech stock.
Right.
But if you actually look under the hood, which is what we're doing today, the mechanics of how it generates that wealth are, well, they're actually fascinating.
Welcome to the Deep Dive. Today we are looking at Enterprise Products Partners, ticker symbol EPD. And the timing here is perfect. It is February 4, 2026.
And they just dropped their fourth quarter and full year 2025 financial results.
And the numbers are just massive.
They're huge.
They are. So our mission today is to unpack how this energy giant pulled off a record year in terms of volume and cash flow. We're going to figure out what terms like operational distributable cash flow actually mean for your wallet.
Right.
And this is the part that I'm still wrapping my head around. We're going to look at how this very traditional, very industrial company is pivoting to become a critical player in the AI revolution.
It's a plot twist most investors just aren't seeing yet.
I'm excited about the sheer scale of the numbers here, but I know you've been digging into this strategy,
Yeah.
specifically some major moves they're making with ExxonMobil.
Yeah, there is a lot of chess being played behind the scenes.
All right, let's dive in. The headline's simple. 2025 was a record-breaking year for Enterprise Products Partners. But, when companies say record year, usually they mean one good quarter, or maybe revenue was up but profit was down.
Yeah, it can be misleading.
But EPD seems to have hit a grand slam here.
It really was a clean sweep. If you just look at the operational side, they didn't break one record. They set 10 separate volume records across the partnership's operations.
10 records. Break that down. What does that actually, physically look like?
So think about what EPD actually does. They don't dig for oil, and they don't sell you gas at the pump. They're midstream.
They move things.
They move things. So 10 records means they moved more volume through their pipelines, stored more liquids in their terminals, and processed or fractionated more hydrocarbons than ever before in their entire history.
And volume is the key word here, isn't it? Because they're basically a toll road.
Precisely. That is the best analogy. If you own a toll road, you don't really care if the cars driving on it are Ferraris or Toyotas.
You just want a lot of cars.
You just care that there are a lot of cars. EPD collects a fee for every barrel that moves through their system. So 10 volume records means traffic was at an all-time high.
And that traffic jam translated directly into money.
It was a financial trifecta. They posted a record gross operating margin, record net income, and record cash flow in the fourth quarter.
That's really impressive. It's one thing to move more product, but to make sure that extra activity actually turns into record profit, that's another challenge. Sometimes costs just scale right up with volume.
True, but this wasn't accidental. And this is, I think, the first key insight for you. These records weren't just good luck because oil prices were high or something.
Right.
In fact, midstream companies are pretty insulated from price swings. This success was fueled by expansion projects that they've been building for years finally coming online.
Okay, so the seeds they planted, 3 or 4 years ago are finally bearing fruit.
Exactly. In this industry, the lead times are so long. You spend billions building the infrastructure, getting permits, laying pipe, building terminals, and for years, money is just going out the door.
And then you turn the valve.
And suddenly, the cash starts flowing in. 2025 was the year the valves opened.
Speaking of cash flowing, let's get technical for just a minute. In their earnings report, this term keeps popping up, distributable cash flow, or DCF.
Mm-hmm.
For a general investor, we look at PE ratios or net income. Why does EPD obsess over DCF?
It's the single most important metric for an entity like this. Because EPD is a master limited partnership, an MLP, investors are primarily looking for income. Net income can be messy because of non-cash charges like depreciation.
And depreciation must be huge in a business with this much physical equipment.
Huge. It can make net income look way smaller than the actual cash in the bank. So distributable cash flow is basically the cash the business generated that could be paid out to investors. after they've covered the maintenance to keep everything running safely.
So it's the take-home pay of the partnership.
That's a perfect way to put it.
Okay, so it's the pile of money available to be handed out. How big was the pile?
For the full year of 2025, their adjusted cash flow from operations was a record, $8.7 billion.
$8.7 billion. Wow. That is a staggering amount of cash.
It is. I mean, to put that in perspective, that's more cash flow than a lot of tech companies generate in a decade. But here's the nuance, and this is what distinguishes EPD from some of the, let's say, riskier high-yield stocks.
Okay.
They didn't just take that $8.7 billion and hand it all out to investors.
They didn't?
No, they're playing a longer game. They retained $3.2 billion of that cash to reinvest back into the business.
Wait, so they kept over $3 billion? Just kept it?
Yep. Just in the fourth quarter alone, they retained $1 billion.
That seems really significant. Usually when I think of high-yield investments, I think of companies scraping together every last penny to pay the dividend.
Yeah.
You know, robbing Peter to pay Paul.
Right.
But EPD is keeping billions in the bank.
And that is the sign of a healthy income machine.
Yeah.
If you're paying out 100% of what you make, you have zero margin for error. If a pipe bursts or you want to build a new terminal, you have to go to the bank and borrow money at, 5% or 6% interest?
Or issue new shares and dilute your current investors.
Exactly. EPD is basically saying, we made so much cash, we can pay you a hefty distribution and still have billions left over to build the next project without begging the bank for a loan.
It's self-funding.
Totally self-funding.
That is a great transition to the payout itself. Because, let's be honest, a lot of people looking at EPD, they're not looking at the pipelines, they're looking at the yield. What are we seeing there?
The distribution yield is currently sitting around 6.7%. Now, depending on the exact minute you check the stock price, you might see 6.28% or 6.7%, but you're generally looking at a yield in that high 6% range.
Which is substantial. I mean, compared to a standard savings account or the broader S&P 500, which pays, 1.5%? This is 4 times that.
It's huge. But you have to be careful. In the market, a high yield can often be a red flag. We call it a yield trap.
Right, the danger zone. Usually the yield is high because the stock price has crashed, because the business is failing.
Or they're paying out more than they can afford, and a cut is coming. But EPD has a track record that just argues against that. They've raised this distribution for 27 consecutive years.
27 years. So through the dot-com crash, the 2008 financial crisis, the COVID pandemic.
Through all of it, they have given their investors a raise every single year for nearly 3 decades. That kind of consistency is just, it's rare.
That's reliability. But let's play devil's advocate here. Past performance doesn't guarantee future results. How safe is it today? We talked about them retaining cash, but is there a specific metric that tells us how safe that payout is right now?
There is. It's called the coverage ratio.
Okay, let's unpack that. Treat me like I'm 5 years old.
Okay, think of it like your personal household budget. If your monthly expenses, rent, food, car are, say, $5,000, and your paycheck is exactly $5,000, your coverage ratio is 1.0.
Breaking even.
You're breaking even. You can pay your bills today. But if your car breaks down...
I'm in trouble. I'm putting it on a credit card.
Yeah, exactly. You're living on the edge. Now, EPD reported a coverage ratio of 1.7 times for the full year.
So, using that budget analogy, for every dollar of bills or distributions they have to pay investors, they actually earned $1.70.
Correct. And in Q4, it was even better, 1.8 times. They have almost double the cash they actually need to pay the distribution.
That sounds incredibly high for a high yielder.
It is. In the midstream world, a 1.2x coverage ratio is usually considered safe.
Okay.
So sitting at 1.7x or 1.8x, that implies a very, very sustainable foundation. It suggests this income machine isn't straining to pay its bills at all. It's just cruising.
So you get a 6.7% yield, and the company's basically saying, don't worry, we have plenty more where that came from.
That is the message the market should be hearing.
Let's talk about where this money is coming from physically. We mentioned the 10 volume records. What kind of equipment or projects are driving this? We aren't just talking about a single pipe in the ground, are we?
No, these are massive industrial complexes. The report highlights a few specific assets. First, the completion of the initial phase of the Neches River Terminal.
The Neches River Terminal.
It's a major export hub. Think of it as a gateway to the world. EPD takes U.S. energy LPG, ethane, and loads it onto these massive ships to go to Asia or Europe.
I see.
Then there's the Bahia Pipeline. This was a major project that was completed recently, and it's already contributing to those volume records.
Is Bahia just for oil?
It's actually for natural gas liquids, or NGLs. When you bring a pipeline like Bahia online, it's like opening a new highway. Suddenly, traffic can flow more efficiently from the Permian Basin to the processing centers.
And EPD collects a toll on every barrel.
That's right, they're the toll booth operators of the energy world.
I love that analogy. They don't own the cars, they just own the road.
And business is booming on the highway.
But building these toll roads isn't cheap. You can't just, 3D print a 500-mile pipeline.
Not at all. In fact, 2025 marked the peak of their current growth capital spending cycle. They invested $4.4 billion in growth capital projects just last year.
$4.4 billion.
Plus another $632 million on acquisitions.
So they spent over $5 billion growing the business in a single year. That's a massive outlay.
It is. But remember what we said about their balance sheet. Because they retain so much cash, they funded almost all of that themselves. They didn't have to dilute shareholders or load up on dangerous amounts of debt.
Ah, there it is. The power of that retained cash. They're self-funding giants.
Exactly. But here is where the narrative shifts a little bit.
Go on.
You mentioned 2025 was the peak of spending.
Right.
Usually when a company passes its spending peak, it means they're kind of done building. They just sit back and collect tolls. EPD is doing something different. They are pivoting to the future.
Okay.
So we need to shift our gaze from the 2025 results to what they're planning for 2026 and 2027.
All right, what's the outlook? Are they slowing down?
Only slightly. The spending isn't stopping. For 2026, they plan to invest between $2.5 billion and $2.9 billion.
That's still a significant chunk of change.
It is, though they do plan to offset about $600 million of that with asset sales selling off older or less strategic pieces to fund the new stuff. And looking even further out to 2027, they're anticipating another $2 to $2.5 billion in investment.
So they are constantly refreshing the machine.
They have to. In energy, if you aren't growing, you're dying. But the nature of the growth is what gets really interesting here. This is where we get to the aha moment of this deep dive.
The AI connection.
Yes. This is the part that, frankly, it surprised me.
Me too. When I think of investing in artificial intelligence, I think of silicon chips. I think of NVIDIA. I think of data centers, software, huge server farms. I certainly do not think of a natural gas pipeline in Texas.
Most people don't, but think about the physics of AI. Those massive digital brains, those AI data centers, are incredibly hungry for power.
I've read about this. A standard Google search takes a tiny bit of electricity. An AI query takes something like 10 times as much.
Exactly. And when you have millions of those queries happening, these data centers consume electricity at a rate that is straining our current electrical grid. The grid simply cannot keep up.
So where does the power come from? Why not just put solar panels on the roof?
You can, and they do, but renewable energy is intermittent. The sun goes down, the wind stops blowing. An AI data center needs 247 consistent baseload power.
Right. You can't have ChatGPT go offline just because it's a cloudy day in Arizona.
Exactly. And the cleanest, most reliable option for that right now is natural gas. EPD explicitly mentioned in this report that they see opportunities to expand their gas pipeline systems specifically to support the growing power demand of AI data centers.
Wow. So they are positioning themselves as the fuel supply for the AI revolution.
It's a key narrative shift. We are seeing old energy infrastructure enabling new tech frontiers. The data centers need reliable power, often generated right on site with natural gas turbines.
And EPD owns the pipes that bring that gas to the door.
That's the play. It's fascinating. It turns a boring pipeline stock into a backdoor play on the tech boom.
It's like selling shovels during a gold rush, except here, they're selling the electricity to run the shovel-making machine.
That's a great way to put it. And they're not just hoping this happens. They're making strategic moves to ensure it does.
And speaking of connections, we have to talk about the partnerships. You mentioned ExxonMobil earlier. That's a name that carries some serious weight. What's going on there?
This is a big deal. EPD isn't just going it alone. They have a new project to expand and extend the Bahia Pipeline, the one we mentioned earlier, in partnership with ExxonMobil.
Partnering with a supermajor like Exxon, that's a strong signal.
It validates the project, for sure. Exxon doesn't partner on projects they think are going to fail. It also shares the risk. And this expansion is targeted to enter service by the fourth quarter of next year, 2027.
So that extends their growth visibility.
Right. Growth visibility is a term Wall Street loves. It just means we know exactly how we're going to make money 2 years from now.
It's not a mystery. It's a contract.
Exactly. And it's not just Exxon. They also mention the Dark Horse facility.
Dark Horse. I love that name.
It is a great name. It's a treating facility in the Delaware Basin. They're expanding that as well. So between Exxon partnership, the AI data center demand, and the dark horse expansion. EPD is not running out of
It
ideas.
sounds like they have a very full plate. But I want to circle back to safety one more time. We talked cash flow coverage, but what about debt? You said they're self-funding, but surely they have some debt.
Oh, they do, certainly. But this is where EPD really shines as a financial fortress. We look at the leverage ratio.
And what is that exactly?
It compares their total debt to their earnings, specifically EBITDA. A lower number is better. It means you could pay off your debt faster. EPD ended the year with a leverage ratio of 3.3 times.
Is that good? 3.3 sounds arbitrary.
Well, context is key. For a capital-intensive industry like midstream energy, where you have to build these massive physical structures, 4.0 or even 4.5 is common.
Okay, so 3.3 is excellent.
It's very low leverage. It means they aren't overextended. Low leverage means safety. If interest rates spike again, or if there's a recession and volume drops slightly, they're not going to be crushed by interest payments. It gives them flexibility.
So a market cap around $75 billion, low debt, high cash flow, clear growth plan.
They're the blue chip of the midstream space.
Okay, so far this sounds almost too perfect. There has to be a catch.
There is a catch, or at least a complexity that scares some people away.
The dreaded tax form.
The K-1.
Let's break this down for the listener because this is where a lot of people get hesitant. EPD is not a normal corporation like Apple or Microsoft, is it?
Correct. EPD is an MLP, a master limited partnership.
And what does that mean come tax season?
It means you do not get a simple 1099 DIV form for your dividends. Instead, you get a Schedule K-1 federal tax form.
And why does that matter? Why is everyone so afraid of the K-1?
It just adds complexity. You're technically a partner in the business, not just a shareholder. So the K-1 details your share of the income, deductions, credits. It's more complicated. It also usually arrives later in the tax season, sometimes in March, which can delay your filing.
And your tax person might charge you extra.
They might, because it's more data entry, so it's a bit of a headache.
Okay.
But, and this is a big but, that structure is also why the yield is so high.
Explain that trade-off.
MLPs generally don't pay corporate income tax at the entity level. They pass that tax obligation and the cash on to you. It avoids double taxation. So you get a bigger payout, but you have to do a little more paperwork.
And isn't part of the distribution tax deferred?
Often, yes. A significant portion is considered a return of capital, which means it's tax deferred until you sell the stock. You get the cash now, but you don't pay taxes on a lot of it until years later.
So you want the income machine, you have to handle the maintenance manual.
That's a perfect way to put it. For many investors, the tax advantages and that 6.7% yield are well worth the extra paperwork. But for others, especially those who just want simplicity, it can be a deal breaker.
Right. It's important to know what you're signing up for. Solid advice. Okay, to wrap this up, let's look at the big picture. We have unpacked a lot today.
We have covered a lot of ground.
We've got a company that just smashed its records in 2025. 10 volume records.
Driven by completed infrastructure projects like the Neches River Terminal and the Bahia Pipeline.
They are flush with cash. We're talking $8.7 billion in operating cash flow with a coverage ratio of 1.7 times.
Which means that 6.7% yield isn't just high, it's incredibly well covered.
And they're retaining billions to self-fund their future, keeping their debt low and their balance sheet almost impenetrable.
And that future isn't just more of the same. It's a pivot toward powering AI data centers and striking massive partnerships with players like ExxonMobil.
It's a rare blend of, boring consistency and really exciting strategic evolution.
It is.
The stock price, as we speak, is hovering around $34.63. It fluctuates, of course, but the underlying argument here is that the machine just works.
It works. It prints cash, it pays investors, and it builds its own future.
So here's the final thought I want to leave you with today. We spend so much time talking about the next big thing. We obsess over the microchips, the software, the algorithms. We chase the shiny objects.
A human nature.
It is. But maybe we're looking at it the wrong way. None of that digital magic happens without electricity. And that electricity has to come from somewhere. As we move into an era of, unprecedented power demand from AI, we have to ask ourselves a question.
What's the question?
Is the smartest play buying the expensive chip stocks that everyone else is buying? Or is the smarter, quieter play actually owning the pipes that deliver the energy required to run those massive digital brains?
That is the multi-billion-dollar question. And looking at EPD's records, I think we know how they would answer it.
I think we do. Thanks for listening to this deep dive into enterprise products partners. We'll catch you on the next one.